I've built the XA investment business from $0, and we run about $1 billion across 3 funds. In Oklahoma, if you are an ambitious person, you can be a lawyer, you can be a doctor, or you can be an oilman. And
That's it?
that's it. Within private equity, we're able to just sort of narrowly focus on, investing in the best private companies in the U.S. and outside the U.S.
And I'm going to be starting actually a roll up myself in grass, like landscaping companies,
Mhm.
right?
Smart. A lot of firms are experimenting right now. They're trying to understand, is this going to save us time when we're researching different investments? I don't think it's AI is going to take over the world. I think it's only in certain specific use cases where we're going to see that impact. People threw that model out the window, which opened the door for.
I'm Garrett Wong, and this is the Investing to Win podcast. How do you define success, and what does winning look like for you? Kim, welcome to the show.
Thank you, Garrett.
I've been looking forward to this. I've been traveling. I was just, I was in Italy a week and a half ago, and before that, I was in Sydney. So I know we've had to kind of reschedule a bunch of times, but better late than never. So why don't we start by having you introduce yourself to the audience and a bit about your background?
Sure. So I'm the president of XA Investments, and I've spent my career largely doing product development and capital raising. I was a Nuveen investments person, very Chicago asset management sort of profile. I'm originally from Oklahoma, which is where my family resides. But I've built the XA investment business from $0, and we run about $1 billion across 3 funds. And we also have a very active consulting and research practice where we focus on private markets. And I'm sure we'll talk more about that.
Wow. Okay. No, that's I've been dabbling, just trying to get because I'm a real estate investor, as you know, and just trying to get the vocabulary of capital investing. I think is really intimidating for a lot of folks. You mentioned Nuveen. Um, what is that exactly?
So Nuveen Investments is one of the top 3 or 4 asset managers in the Chicago area. I think listeners might know Nuveen for the municipal bond heritage. They have a lot of municipal bond investment funds. Nuveen is also part of the TIA-CREF family. So for people who have their retirement plan with TIA, they may also recognize Nuveen. And for me, it was a great place to start my asset management career, where I had terrific mentorship and helped me get to the place where I am now to build my own business.
Yeah. Wow. Why don't we take me back like further, right? Um, what did you do before the capital raising, or even before in Chicago?
Well, so I mentioned that I grew up in Oklahoma, and in
Yeah.
Oklahoma, if you are an ambitious person, you can be a lawyer, you can be a doctor, or you can be an oilman. And
That's it.
that's it. That's it. Those are the choices, and you could be quite successful. I mean, it's a wonderful place. And I come from a family of physicians and surgeons, and I did not want to be, living my days in a hospital. So I figured out that investment banking was the place I wanted to go. And so I started my career out of Notre Dame in the Chicago office of Morgan Stanley, where I did investment banking. And in Chicago, we were all generalists, which just meant that we covered every sector. And so I got a lot of great industry exposure working at Morgan Stanley. But also, as a young professional woman who wanted to have a family, I figured out that I did not want to be an investment banker, and ended up going to business school thinking that I like to write, thinking that I wanted to do equity research, and did a summer doing that, and decided I was I was not very, it's kind of a lonely job to do equity research. So that's how I got into the capital market side of things in terms of product development and capital raising, because within asset management, that's the most like investment banking. And so I was able to marry what I enjoyed doing with an area of the capital markets that's always changing. It's very dynamic. And having started my career as a generalist in investment banking, I think that was terrific in terms of applicability to the capital market side of asset management. And so my career has also been spent. Um, I've been able to work on a wide variety of investments in public markets, in private markets, and that's a lot of fun as you spend time understanding the risks, understanding the return opportunity in those varied public and private investment sets.
Okay. You've mentioned equity research a couple of times in the last 5 minutes. Can you maybe enlighten myself, but even the audience, about what that entails?
You know, when I spent a summer doing equity research, I was going deep into the financials, understanding the toy industry. And so I think this is helpful. Think about publicly traded companies at that time. It's Mattel, it's Hasbro, Leapfrog, Toys R Us. And it's fascinating because you understand the growth dynamics of those businesses. Now, most of those businesses are pretty well established, and within equity research, it's effectively developing a investment thesis. Are you going to buy, this stock? Are you gonna put it on the sell list? And it's sort of a solitary as you go deep into the company's financials and try to make projections on where they're headed. It's a really interesting job, but I found that I wasn't interacting with people as much as I love to do. So equity research, just think of it as stock selection, stock picking, and active management is predicated on picking the right stocks, and that's different than buying an ETF that's passive or index based, where you just buy the whole index. In this case, I was working for Capital Group that summer. Capital Group owns the American funds, which a lot of listeners are probably familiar with, and they're an active investor in mutual funds and ETFs. And so they were trying to determine which stocks are going to outperform, in the months to come. And I think American funds and the Capital Group, they took a long-term perspective, so you could develop a thesis that could sort of anticipate what would happen in those stocks that I was analyzing.
You know, come across, obviously, I've been traveling around the world, and I have a really starting to make a network into your world, I believe. But maybe could you? I see a lot of investment bankers. They talk about the lifestyle or the lack thereof. Can you kind of describe that feeling that you had and not wanting that? And maybe, I mean, it's not a movie, but maybe the movies portray it well. I mean, enlighten us on that.
Well, I think, as a young person, what I always say is, if you're right out of college and you have the opportunity to work in an investment bank, or even, what you want is to be trained, you want mentorship, you want to soak up the knowledge. And what a better moment in time to do that when you're 22 or 23, right? You don't have a dog, you don't have kids, you don't have a mortgage, and it's a lot of fun because in investment banking, frankly, you're sitting in a bullpen with really smart people who've graduated from top colleges, and you're all doing similar work. So when you run into a problem, if you're analyzing a company or if you're looking at an acquisition, if you so there's all sorts of people to learn from and to tap into that knowledge. So I think that's the upside of investment banking, because it's fast paced. You're working with some of the best and brightest. The downside is you tend to do it anywhere from 80 to 100 hours a week.
Yeah.
And if you don't need to, go home to, you know, tuck your daughter into bed, then that's fine. But I think you can kind of see the future. And I always encourage young people on my team, think out 5, 7 years in terms of what you're going to want your day to day to be. And, and for me, I thought investment banking was fantastic because you got to, develop these terrific friendships and go up that learning curve. But then once you're up the learning curve, it gave you a lot of different options, because I think what students in college fail to realize, they just don't have the exposure to realize there's so many different areas within investing, and you can have a really terrific career doing something you probably never heard of. You hear about equity research, you hear about investment banking, but there's probably 50 other really cool jobs that, until you get some exposure, you don't realize that might be a better fit with your natural skills and your strengths.
Okay. And contrast that to the world of private equity, because I mean, I think I have the vocabulary now to distinguish the two. Um, what is private equity from your classical definition?
Well, I mean, many investment bankers, because of that experience, end up going into private equity at a later point in their career. With investment banking, the services and the career paths, it's very, meaning investment banks are serving public companies, private companies, and everything. Their span of services is wide. Within private equity, we're able to just sort of narrowly focus on, investing in the best private companies in the US and outside the US. Different private equity firms have different focuses. Maybe some are early stage investors, and that would be called venture. And some of those investors are more tech focused, or maybe they're software focused. So some of these specialties develop, and private equity firms become well known for a certain area of investment where they have expertise. And I think lately there've been a lot of larger companies that have been bought out, and those are called leveraged buyouts, because those are actually large, well-established businesses that are taken private. And I think, Garrett, this area of private equity is really interesting now, more so maybe than 5 or 10 years ago, because so many companies that are of interest, like XAI or some of the other AI companies, those are all private companies. And so, how do
Hmm.
Americans get access to this area of the technology market? You have to be able to invest in private equity to participate in that stage of early growth. And so many companies are staying private longer. There's much talk about unicorns, which are very large private companies that are, either waiting to go public or are being acquired at a much larger state of their growth curve. So, from a I, there's a lot of different types of private equity, and more of this is, I would say, becoming sort of well understood, because there's more media, there's more focus on what's happening with these private companies in a way that there didn't used to be as much focus.
Hmm. We'll get back to that in a second. Thank you for that. Where does XA Investments, like, if you were at a networking event and you were to introduce XA Investments, how would you position it? Like, what exactly do you do, and who do you serve?
Sure. So we basically help asset managers figure out a way to expand their investor audience and open up these firms to tap into the growing retail marketplace. And we do so because we have expertise in, you know, registered products, not private funds, but SEC registered products that are easy for individual investors to purchase. They also have 1099s, so it's easier from a tax perspective. So the the intersection of our expertise, which is developing these types of funds to make them accessible at a time when many more private markets asset managers are trying to, get in front of individual investors. It's just this natural intersection that's happened lately, where you're seeing a lot of leading alternative firms, Blackstone, KKR, Apollo, Blue Owl. These firms are all expanding beyond their institutional investor base that they've been focused on in the past. And now they're focused on individual investors. So it's a really interesting time. And I think it presents a lot of choice. There's some complexity here. So we have to kind of unpack that. What does it mean for individual investors to have these choices? But that's what we're helping asset managers do, is put their best foot forward to package up their institutional investment capabilities in a way that makes sense for individual investors.
So to clarify, um, you're trying to bridge this gap for more traditional investments, perhaps something that is not private equity because it's too difficult for the average person to invest in private equity, or am I misunderstanding?
No, I think you're right. So historically, private equity funds, to raise capital, they would put together a private fund, and a private fund has K1s for tax purposes. They also have minimum investor suitability requirements, and so not everybody can buy a private fund. If you're a wealthy um, individual, you probably have been able to access private equity through a private fund. But most average US investors, they buy mutual funds, they buy ETFs, maybe they buy individual stocks. Um, and so basically you need is a way to make private equity and private infrastructure, private credit, a whole array of alternative investment strategies now put into sort of the market in a way that individual investors are used to investing. And I think with your real estate experience, the analogous structure for real estate was some of the REITs. You've got listed REITs, you've got
Sure.
non traded REITs. So this is just another expansion in terms of product innovation, because a REIT is actually a pretty good way to get diversified access to real estate in a way that's easy for investors to purchase. And our expertise is in a product structure that's called an interval fund. It's a type of SEC registered product. It's not a mutual fund, it's not an ETF, but it sits on the same shelf with those other SEC registered products. And you can basically put any alternative investment. Right now, what's popular is private equity and private credit. But uh, as you know, with a non-traded REIT or a listed REIT, the only thing that works in a REIT is something that's real estate eligible. It's got to be real estate
Of
focused.
course.
So these
Yes.
product structures are a little bit broader than real estate. There actually is a big category of real estate funds in the part of the market that we serve.
Okay. So one of the passions that I like, so I yes, I started out as a real estate person and I have obviously some investments, but I've been taking a really keen interest in PE and roll ups, right?
Mhm.
Specifically, fragmented industries like home services, which are somewhat AI resistant. And I'm going to be starting actually a roll up myself in grass, like landscaping
Mhm.
companies, right?
Smart.
Can you kind of so from again, this is more exploratory for myself. That's why the show I told you in the green room is going to go wherever it might go, right? It's not just here's 10 questions and we're going to hopefully we're not going to go past time because I know you probably have a hard stop. But when we're talking about private equity from what I'm understanding, you can then do some equity research and give your clients access through things like interval funds to be able to go in then and maybe choose a roll up or maybe a company that's very young in its cycle, maybe 4 million EBITDA, and they're trying to, go into that first stage of natural arbitrage. Is that kind of accurate?
Most of the funds, because of the rules, the SEC rules are diversified. So you're going to get, the nice thing is you're going to get exposure to a number of different companies, and they just like you see in the mutual fund space, like you got large cap growth. The same thing might be true in an private equity fund that's diversified. So let's say the manager is actively managing a portfolio of different private equity investments, but they're middle market growth focused.
Right.
So an example of, and I think the roll ups that you're talking about, I think some of your listeners can relate because, like, my kid's orthodontist is now part of a private equity roll up. You've seen that with veterinary services. I've got a
Yep.
friend in
Dental
Texas,
groups.
dental
Yep.
groups.
Accounting. Yep.
Yes. And, like you're saying, home services, I've got a friend who's got an HVAC business in Texas and he's rolling up several of them. So I think that private equity does deploy capital in those areas because it's like if it works to buy one dental practice, why not? Why not buy 20, right? Because you've got the model, you've got the math, and you can, those businesses are growing. And so in a diversified portfolio, the benefit of that is that there's risk that you're taking on as a private equity or a venture capital investor, and part of what you want them to do is put together a number of different investment opportunities in an area where they've had past success. And as we were talking, these private equity firms don't jump from opportunity to opportunity. They tend to be very focused in an industry and very focused on a company market capitalization or a size of company. That's their
Hmm.
sweet spot, and so that's what's being presented in the market this year. We actually saw a couple tech focused private equity funds launched, and obviously tech is driving the public markets, but it's also driving some of this thematic investing on the private market side as well.
Yeah. I mean, roll ups, again, right? I don't want to say that's the hot thing right now, but it appears to be, right? It seems like almost everybody is trying to do it. What is your opinion for AI and in specifically AI, employee AI type of companies and rolling those up? Because you see, again, it's doing it, and I'm very cautious because you've got big, huge players to compete with if you're trying to do an AI roll up right now. I'd rather just stick to my little lawnmowers and my shovels. What's your opinion on that?
Well, I think that when you think about the implications for asset management or private markets, I think that a lot of firms are experimenting right now. They're trying to understand, is this going to save us time when we're researching different investments? What's the impact to our investment process? So I think that there are going to be huge implications. At the portfolio level in terms of the type of businesses they buy. But right now, I think most asset managers are focused on getting efficiencies, in the research process for themselves. So I think you're smart to focus on areas, to the extent that these roll ups, aren't driven by technology or AI. I was reading that plumbers and electricians, their compensation is going through the roof, and there is a sort of an indirect reason because at least with electricians they're being called to help in terms of these data warehouses that are being built out.
Hmm.
So I think that there can be some knock-on effects that are positive in terms of growth of certain communities that are hubs for development for AI. And I think everyone's just trying to figure out what are those direct and indirect impacts. And there's a lot of money and time being spent right now. So the actual efficiencies that people are gaining from AI, I think, are actually being reported by the Wall Street Journal as being less than people sort of would have guessed. We too are experimenting it with our firm in terms of like, what can you actually have AI help you do that a human being isn't needed to do? And right now it's actually fairly few functions. Um, we work with a lot of members of the media, and so right now we're using AI, for example, to do article summaries,
Hmm.
because that saves an analyst maybe 30 minutes of time so they don't have to put together a summary themselves. So I think some of these use cases, you know, on the margin aren't moving things, but I like your idea of sort of investing in businesses that are going to be immune or, mostly immune
Resistant, yeah,
resistant.
resistant.
Yes. Yes.
I worry. One of the things that keeps me up at night as I'm starting this roll up, because we're going to be the platform company. And obviously, when I talk about fragmented industry, I'm saying this for the benefit of the audience. Kim obviously knows fragmented industries in private equity are where you have lots of small companies that can be either purchased or partnered with or things like that, like grass and snow, or like plumbers who typically have one or two apprentices, maybe two or three trucks if they're a little bit bigger, making lots of money, but not necessarily having the business infrastructure for integrating and merging those systems together to take on another service book of business, to have a technology platform for tickets and service requests and GPS locators and things like that, as opposed to having very few players and lots of really really large companies, right? So that's why I think a lot of people are doing this. What keeps me up at night is picturing that I'm going to do this roll up and all of a sudden, you know, AI robots are going to come out and you're going to see them mowing the lawn and all these types of things. And that could disrupt that industry as well. Meanwhile, you've got plumbers and electricians. Other than being a little bit more efficient with AI, I can't at least intellectually get there and see how AI is going to take over physically somebody going there and soldering a pipe and diagnosing a problem, at least maybe not in my lifetime. Would you agree with that?
I would, and I think that's why with a lot of the hype, you have to be thoughtful the way you are and say, plumbers and electricians, these are skilled tradespeople, and they've been doing this a long time. And so you have to ask the question, can this change my day to day? And what's it really going to be the impact? And I think if you're having those conversations with people that run those businesses today, they're the ones that are going to be able to anticipate, any potential positive implications, but also protect the business from potential cannibalization to the extent there will be. And I think that, uh, you know, um, worrying, or I think you're being very thoughtful, as you should be, because like. I don't think it's AI is going to take over the world. I think it's only in certain specific use cases where we're going to see that impact. Um, I think I think young people coming out of college, though, there's at least going to be a period of time where, graduates are not being hired straight off the bat, to the extent that there's reductions in the number of analysts that are being hired coming out of college. So I think college graduates have got to be thoughtful too, in terms of where they spend their time in college, and make sure that there's some wisdom in terms of what plumbers and electricians, they know that they're always going to be in need. There's a demand for that, and I think college graduates need to give that some thought too, right? Is this area of study going to be fruitful going forward? And I think some universities are trying to equip students with that knowledge and know-how to get ahead of that question, but burying your head in the sand is not the answer.
Yeah, that's a really good point, Kim. My son, he's 21. He was going through business IT at one of the local colleges here. And I mean, that's a very broad industry. You can basically go anywhere, but picture somebody traditionally 10, 15 years ago who went to university, got a computer science degree with a specialty in computer programming, a
Right.
code writer, if you will. I'm pretty sure that AI can write code better than and faster. Like I'm pretty sure that that industry has been disrupted, as
Hmm.
with Uber and other things. It's very difficult. I would not want to be a computer programmer right now or anything where it can be literally taken over by AI.
You'd want to be one with 20 years of experience, but not one with less than a year of experience. And that, so I think we all have to anticipate there's plenty of careers and professions which are apprenticeship models. Even in my business, you learn the craft by having elder statesmen above you that to learn from. And that's true
Yes.
for plumbing, and it's true for a lot of areas. And in 20 years, if we don't have this crop of kids that are in their 20s, so that's what I worry about is, you may be able to reduce some jobs today, but in 20 years you're still going to need that senior coder, right?
The human being
The
that's
human.
driving the ship. Yeah.
Yes. So, I think that's a real question for us in terms of, like, you still need to cultivate talent and learning over time. And if you cut off one end of the pipeline, what's that going to mean for us in 10 or 20 years? There's going to be a scarcity of talent at that point, I think, is part of the issue.
Yeah. AI to me is very interesting because we've been a property management company around for 28 years. So I've literally seen it all. And lately, so I also am a self-professed kind of a computer nerd, and I hire other computer nerds. So I almost like to say that we're a technology firm that happens to do property management. So we're on kind of on the forefront of AI voice agents and
Hmm.
booking. And like, for example, I used to have a sales assistant that was answering fielding calls, and now a fully AI capable voice agent will answer the phone, triage, find out, go into my calendar and book an actual appointment for me, and then give me a summary so that I know what I'm walking into. Um, but at the same time, when you talk about other industries, so what I'm trying to say is, despite all of my experience with that, I can't. I'm very afraid to jump into an AI roll up because of
Mm,
the race. It just
mm,
seems so risky because you're racing with everybody.
mm.
And the only thing right now that I can see are AI business support services is like totally hot right now because everybody's trying to catch up. But now you're racing with everybody and you're going against Grok and OpenAI and huge players who are literally hiring. They're buying other companies just for the founders and the coders within those companies. It's
Yeah,
crazy.
yeah. And they're well funded too. So it's not
Yeah.
just, smart folks. It's well funded people that are, so I agree with that. That's probably a losing race, if you will. And but that's why there's so many other pockets in terms of small businesses and roll-ups where
Yes.
there's capital that's not chasing it. So that might actually mean that it's going to be, from a value perspective, an awesome opportunity or an entry point, right?
What's your educated opinion, Kim, on private equity and what they would look at as the untested AI roll up for maybe billions-dollar exits versus the tried and tested and true, very stable little engine that could with the home services roll up, the dental practice roll up.
Well, I mean, I think there's a private equity buyer for both businesses, right? I think, and there's private equity firms that are investing heavily in both spaces, and that's what actually has led to, if you're going to do a roll up, in terms of grass and snow, I mean. The buyer of that business, once you roll it up in 5 years, 7 years, is probably a private equity buyer because they're going to combine it with something larger. So that's why I
Yes.
think a lot of exits for private equity, it used to be strategic company buyers, but now it's a lot of times another bigger private equity buyer. So,
It's another
um,
level. Yeah.
yeah, and a part of it is, the private equity firms are standing in buying, because it used to be that an IPO was sort of the end state for these companies
Right.
going
Right.
public, but the number of public companies has shrunk so significantly. And if you look back in time, there have been sort of moments where the public market, contracted and expanded again. So, in talking with people at the New York Stock Exchange and the London Stock Exchange, given the work that we do, there's a lot of focus by the exchanges and by capital markets bankers at some of the largest investment banking shops to try. And that's why I think with the Trump administration, they're trying to actually make it easier for companies in terms of moving from quarterly reporting to maybe semi-annual, because, like, the overall health and wellness of the US economy is going to be better if our public equity markets are working well. And a sign
Hmm.
that they're working is more of these companies going public. So that's why I think you're going to hear more about this, because, we don't we need companies, and then every investor, once a company's gone public, you can buy the stock very easily. um, but private markets is still, there's still, even though our goal is to make it easier, you still need a financial advisor. There's still sort of,
Right.
things in the way. There's nothing easier than buying a publicly traded company on the New York Stock Exchange. So I think we'll see more focus on trying to open up, you know, and but to the extent that a company is able to finance itself and is you know clear of some of the regulatory burdens, that's not going to change, and these companies are going to stay private.
Well, yeah, and to your point, I mean, you're not going to have a homegrown investor watch a couple of YouTube videos, listen to a podcast, and then start dabbling in private equity. And at the end of the day, all those firms want is what everybody wants. They want a return for their investors, right? That's kind of how the different levels work. Let's shift gears just slightly. I don't want to dominate just on private equity. Tell me about private credit, because I haven't heard of it, but again, being a real estate person, why don't you educate us on what that is?
So there's a good bridge from the conversation we were just having about private equity to private credit, because one of the biggest areas right now is direct lending. So as everyone knows, banks don't lend to small, medium, and large businesses the way they used to, partly because of their capital constraints and some of the regulations that prohibit banks from being as active. And so what's happened, and I think in the US this is a sign of functioning capital markets, there are private lenders that have stepped in to fill the gaps left behind by the banks. So direct lending is happening across America to medium and large size businesses. It used to be that these companies would finance themselves with high yield or senior loans, which were issued by banks. And now, this part of the private credit market, direct lending, if a company is bought by a private equity shop, or if it's bought by another corporation, oftentimes debt is part of the purchase, to finance that acquisition. And so direct lending is standing ready to help finance acquisitions by private equity firms. And so there's a close relationship that private equity firms have with direct lenders, because they turn to the direct lenders now in a way that 10 or 15 years ago they used to turn to the banks to help them finance those purchases. And so direct lending is attractive for a lot of investors. The yields are 9, 10, 11, 12%, so higher yields than what you would see in the bank loan market or in the high yield market today. And the direct lending market is growing fantastically, because the trend continues that banks aren't lending, and so these private lenders have to step into that. It's a good business for them. um, the other part of private credit, because the reality is there's a lot of different types of credit and lending that's happening away from the public markets. Another popular category of private credit in this year in particular was asset-backed lending. So if you're concerned about corporate credit, right, there's been some volatility in the equity market this year. So asset-backed lending, which is backed by actual tangible property, um, that has been an alternative for advisors and investors that are still looking for those fairly high attractive yields, but they like the fact that it's not just a corporate balance sheet backing the loan. It's actually, a tangible asset or piece of equipment, for example. And so asset backed lending, especially in a market where we're still a bit worried about inflation, and that's why asset backed lending has grown so much this year.
I want to dive into that a little bit deeper, Kim, if you will. So to me, so I have access to private lending in terms of hard money lenders, but these are just individuals that have a few $100,000. Now, whether they're accredited or not, I mean, we don't have to get into that whole thing, but let's pretend you have an accredited investor, not as big as a family office, somebody who follows all those rules and meets that criteria, sorry, and they have $400,000 that they want to lend out. Now, they can, again, I'm talking about my real estate world, right? Let's say I want to flip a property and I have a relationship,
Mhm.
or I'm going through my broker and I can get access to those funds. Are you like how does the private credit market, like when you're talking about direct lending, are these individuals who are maybe accredited investing into a fund with an EMD or an exempt market dealer? Like that's the language that I understand from real estate. How does it
Yes.
work in your world?
Yeah, I mean, most of this is sort of B2B, business to business loans, and
Yeah.
these portfolios are well diversified in terms of the underlying loans in the portfolio. Um, you know, there are actually a few P2P, person to person lending outfits, like SoFi is a good example, where individuals. Can take part of their sort of investment portfolio and put it to work deployed into person to person loans. A lot of that because institutions, because those yields were fairly high, um, institutions started bidding on some of those assets. So you actually see sort of a professionalization of that part of the lending market. Anytime I think there's an attractive risk return in lending, you tend to have bigger investors step in. And so I'd say everything that I tend to focus on is something that's a diversified portfolio, actively managed by one of the leading um, managers in that space. I think there are plenty of direct to consumer or direct to investor opportunities. We see it in lending, as you talked about. We see it in like farmland investing. We see it in real estate. And I think that depending on someone's background professionally, their expertise, like if you have, you know, um, family background in farming, you might be able to make an investment decision and go on Acre Trader and deploy capital. I'd say most Americans don't have enough experience or sophistication. I think we find it more in real estate and in farmland where they've had plenty of opportunities in their personal portfolio to make investments. Maybe it's a portfolio of multifamily properties or single family homes. And so in direct lending, we're not seeing that quite as much just because once there's an opportunity, so much of that capital crowds in. Um, and I think that there's still opportunities to go direct. Um, and you're taking additional risk doing it, but oftentimes there's return potential compensating investors to go make those direct investments in areas that they're comfortable.
Okay. Okay. Um, when you talk about B2B lending, so let's say that would be something like my roll up. Okay. So let's say that I'm the platform company and I want to buy John's plumbing, and John wants $400,000 for that. Is that the type of lending that you're talking about? And how would myself, well, I'm not going into a plumbing roll up, but how would a company
Mhm.
is that B2B lending? Is that what the type
Well,
of thing that
at,
would fit that buy box?
yes, I mean any business, regardless of size, to the extent you're faced off with another business whose business it is to lend, I think there's lending happening all the way up the capitalization, and some of the opportunities that you're hearing about in the headlines are happening at the largest US companies taking capital from these private investors, very large deal sizes. But to your point, the direct lending is also happening down here because banks have stepped back from lending to any sized business, right? And I think it's probably more acute for small businesses, which is also
Hmm.
why, the one area of a bright spot there is the SBA loan market, which is still,
Yes.
alive and well. and part of the reason is that it's hard to get loans otherwise, and so that's why you see, I would imagine that in the roll up work that you're doing, a lot of those businesses might have taken SBA loans to
Yes,
expand their
correct.
business, and that's terrific because that's a federal loan to a business, and actually it's a very advantaged rate too, right? That's there's a nice benefit there. But you're right. I mean, all the lending is happening up and down the spectrum because, like, if you're a bigger lender and you've got, let's say, 100 billion assets in your portfolio, you've got to lend to much larger size companies. And
Right.
so, depending on your scale, that will dictate your focus in terms of when you deploy capital. Um, because you've kind of got to marry up, how much capital you need to deploy, how quickly you need to deploy it.
Well, I mean, so let's have another fictitious example. Let's say that I own a dog grooming shop and I invented a better grooming brush, and maybe I put a patent on it, provisional patent. Maybe I don't, but I need $50,000 to buy inventory. Is that accessible through the direct lending market?
I've not that's a good example, and I would think that that would be like
Because
sometimes
that's
people.
small business,
It
right? Like that
is.
happens every day.
It is, and I think there are some factoring companies that will extend loans in the form of, receivables to facilitate some of the cash flow needs for small businesses. But in the it's not a world I'm as familiar with, but I know that a lot of small businesses need to do that because if you're carrying large inventory costs, you've got to finance it somehow. So I know that some SBA loans are used. I mean, there's basically a variety of use cases in terms of how you deploy the proceeds. But I think it's part of what you're pointing out is that it's challenging for small businesses. You have even fewer options in terms of ready lenders. The big companies, they have a lot of people competing for those loans, and the result of that is that as a small business, you're probably going to pay more in terms of the percentage yield on that loan that you're effectively paying. So I think I wish there were more options. Um, in terms of, facilitating that, because do you have a sense, Garrett, in terms of where some of those small business loans, where what the cost of that capital is?
Well, I mean, I can tell you through up here in Canada in credit unions. Let's just go back to COVID as an example, right? So
Sure.
myself, like Upper Edge Property Management, had some COVID relief there, and after like 2 or 3 years, it was called the SEBA loan up here. It turned into like they would forgive one portion, but then you had to turn the other part into something. You either had to pay it back, or hopefully your bank would give you term on it, whether it's 3, 4, 5 years, etc. And I was told, even though our company does over $1 million a year, that because we are a service industry and don't have actual backed real estate, we don't own our office, we lease, we don't have inventory that we can pledge against something, they wouldn't do it for us. I actually had to go into my other, like basically refinance a property to do it.
Mm.
It was very interesting. And I see what you're saying, that lending at the banking level and financial institutions is definitely changing.
Yeah, I mean, it makes it that much harder if you're starting out to launch a new business. So that's also,
Absolutely.
that's part of the pipeline problem we were talking about earlier. It's not just people and their career growth; it's businesses too, right? To the extent that, in terms of American small businesses, a lot of that used to be fueled by bank lending, but so there is a gap, and at least some of these direct lenders have stepped in to help with it. um, and it's still challenging to be a business owner, um, for sure.
It definitely is. It definitely is. I feel like I've taken you off track a little bit. Change the channel. Why don't we let's go back. There's something that I was when I was doing my research on your firm. You talked about like 60/40 and this traditional way, and you're trying to redefine that landscape. Can you maybe enlighten us on that?
Yeah, I mean, I think that for when people talk about a balanced or a well diversified retirement portfolio, you know the model for that was 60% in public equity and a 40% allocation to fixed income. And as people age or get closer to, retirement, the allocation to fixed income increases. Um, but I think largely that construct, in 2022, when both stocks and bonds, resulted in negative returns, I think people threw that model out the window, which opened the door for an allocation to private market investments. And most US investors are, over allocated to public equity, largely public equity. And I think with the focus also on large cap tech firms. So when you think about the classic capital markets asset allocation model, um, which a lot of very smart academics have studied, to have a well diversified portfolio means you have real estate. It means you have assets that are going to work when the equity markets are not working. And so you introduce new assets. Maybe they love gold right now. That's a diversifying asset. Crypto could also be a diversifying
Hmm.
asset. But what you want is in the portfolio assets that behave differently at different points in time. And that brings the diversification potential. So I think a lot of uh, wealth management advisory practices have been looking at, like, what do you really need to do to optimize your retirement portfolio, and where are you going to, if let's say you're a risk taker and you want to go into private equity or venture capital, you may benefit from taking your part of your public equity portfolio and putting into private equity or putting it into venture capital, especially if you have a longer time horizon. I mean, if you're 30 and you've got 30 years, 35 years before you retire, you should be availing yourself of some of these longer duration, longer time period hold assets because you've got time, right? If you look at what endowments do, endowments have a very long time horizon. We'll see most endowments have half of their investment portfolio invested in things that are private markets. Real estate is very popular, private equity. Um, those two assets, private equity and real estate, comprise a significant portion of most endowment portfolios because over long periods of time, they've been shown to perform well. Now, any 1 year, 3 year short sort of time horizon, that kind of goes out the window because, and that's why I think most people have a preference for highly liquid things. In reality, you're not going to liquidate your portfolio for retirement in a single day. That's not the behavior. So I think there's this tension between what people think they need and then what they actually do in practice. And so private markets kind of challenges some of that traditional thinking. It challenges the 60/40. And there isn't a new mental model yet that's replaced the 60/40. And so we'll see going forward, like, what's the optimal mix of public and private. I think it has to be about the outcome that you're looking for. And an outcome, if you're an income investor, you're going to need 80% of the portfolio kicking off cash flow. And if you don't need the income, you're going to be a total return investor. So you might be more likely to go into things like private equity, which are total return focused. So you're going to hear a lot more about people talking about outcomes, um, because the private markets, when introduced to the portfolio, can help you solve for a different set of outcomes than if you're just talking about public equity and public debt.
I mean, I think ultimately, look, the landscape's changing, right? And I wanted to ask because really, you said you're bridging the gaps. You're trying to educate managers because really, it's people who are with the fund managers, and it's the fund managers who are recommending things. Have you had any kind of pushback or resistance to these types of alternative investments? Maybe the fact that they're maybe not as liquid, or and how are you trying to educate the managers that you're in contact with?
Yeah, especially now. that we're a few years into the build out of these types of private market investments for individuals, especially as I think I think that there's a part of the population that wants to protect people, protect them from bad decisions or bad investments. So we're going to hear that the volume increase on that refrain. And I do think that when you're investing in real estate, you need to work with a professional advisor who has experience. The same thing would be true if you're investing in private equity. You should talk with your financial advisor, your tax consultant. Like
For
there is a
sure.
lot of benefit, but it comes with complexity. And so, if you're a do-it-yourself investor and you're fine with the choices you have in individual stocks and ETFs, I think it's going to be a little while before some of these private markets opportunities become available, um, sort of to the mass market. Right now, it's still sort of being limited and being gated because of the concern I think that you're raising, which is that if you go into a private equity portfolio and your time horizon is not 10 or 12 years, and you say, well, I want my money back in 2 years, and that's a problem, right? There's a disconnect. And so that's why it's like you need to be thoughtful going in on the front end and make sure this is actually going to make sense for your investment goals. And that's why it's worth a holistic conversation. And I don't really think that investors need to be protected from these choices, but I think there needs to be a lot more education. The burden for saving for retirement is on everyone's shoulders, right? We don't have pension plans anymore in the US, or most of us don't. And so I want investors to have more choice, including private markets, but it should be with the appropriate amount of education and explanation of the risk, which are just, risks exist across public markets too, but it's a different set of risks when you're talking about private equity or infrastructure or private credit. And so that's what you're going to start hearing a lot more about. I don't want to keep people from these opportunities, but we want to make sure they're, eyes wide open when they do invest.
Yeah, and for so if there's, I mean, I have a lot of financial um, in that space, people, advisors, and things like that. So if anybody's listening to this podcast and they're a financial advisor, what would you recommend to as first steps to start even thinking about integrating alternatives into their client portfolios?
Yeah, I think start by looking up interval fund. Learn a little bit more about what an interval fund is because, it's not a mutual fund or an ETF, but it's under the same SEC set of rules and regulations. So you're going to start seeing interval funds. Now that I mention it, you're going to start seeing it everywhere because this is. The chassis, if you will. This is how these private markets are going to be presented to you. And there's a lot of fantastic alternative investment managers. They've been running money for institutional clients and they're now making it available to a much larger audience. So start by looking, we have resources on interval fund education on our website. The leading alternative asset managers have like Apollo has a university dedicated to teaching advisors about the private markets. And so there's a lot of good resources that weren't available a few years ago for advisors who are interested in incorporating interval funds into their practice.
Okay. Well, can't believe an hour's flown by. It's just been such a really, it's been I don't want to say surprise because that's maybe devaluing some of my other guests, but you can tell that I love talking about this stuff. And you're clearly so articulate and an expert in your field. So I wanted to thank you for that. But before I let you go, I always ask every guest the same question, and I want to hear what you have to say. So, Kim, this is the Investing to Win podcast. How do you define success and what does winning look like for you?
Success, yes. So my definition of success is to keep going and every day put as much energy into building my business. The reason I say that is, you need to be healthy, you need to be clear of mind to keep putting in the time and the energy, and frankly to develop the type of expertise. You got to keep building those sort of that arsenal of knowledge. And so for me, success has been being able to share what it is that I know about private markets and ways to access it with others. And our business is just growing in leaps and bounds. We had a record year last year, a record year this year, and so I think success is just kind of going along with the fast ride. And listen, I think that success means something different. My oldest son is about to go off to college, so I'm trying to impart, some of that wisdom to him in terms of, success means, a happy life, and happy is different for everybody. I wish other business builders much continued happiness and success, and just keep going. I think that'll get you there in the end.
Great answer. Great answer. Well, like I said, it's been a pleasure. I will get some particulars from you after the show, and we'll put that into the show notes so people can get in touch with you, learn a little bit more about that. But other than that, thanks again for coming on the show today.
Thanks, Garrett. I appreciate it.
Okay, take care.